Welcome to Bunnex Investment Group. In this video, we are going to review a professional trading routine every serious trader must follow. By serious trader, we mean those who wish to take trading as their career, actually going out of their 9 to 5, going into trading full time. So this is a simplified blueprint that will nurture the rightful trading mindset. So by rightful trading mindset, we are saying someone who doesn't have ego towards the markets, who is patient as well as disciplined. But before we go through, make sure you subscribe to this channel and check the notification bell icon if you haven't done so. So the first thing on our trading routine, which is for professional traders, is what to do when there is news. So the first step of every professional trader is to check news. I'm sure if you go around YouTube, you would see that there are some traders who actually encourage scalping during news. But I'm here to tell you otherwise, because some news releases disrupts technicals. Technicals that were supposed to work out the way you know the patterns will not be followed when there are those high impact news releases. So news can be checked on several websites, including fxstreet.com, forexfactory.com, or even investing.com. You can check the news and they are actually classified as high impact, red folders, orange folders, as well as white folders. So you'd see that whenever there are red folders, you'd know that it's actually a high impact release. So it's better to actually approach that with caution. So it is therefore better to avoid being in a trade while there is high impact news ahead. So it now depends on where you are in the cycle. In our case, we trade the institutional market maker method, which we also teach. And if you are within the cycles, that is in between level 2 and level 3, it is also okay to actually hold your trades through the high impact news. But if you are at the peaks, right, we always say our cycle is like this. If you are trading at this zone or this zone, it's better to actually avoid trading that high impact news, because at these points there's a lot of room for market makers to actually manipulate the market, widen the spreads so that they clear off all contracts before moving in the rightful direction. So after checking the news, you should actually, one, avoid trading non-farm payroll at all, right? This applies to inexperienced traders. If you do not you haven't been in trading and you haven't been profitable for at least 6 to 8 months, it means you are still in the novice side. So you should actually avoid trading non-farm payroll or NFP. And then you should also avoid trading when the Federal Reserve chair speech is actually running. That is when Jerome Powell is actually giving out a speech. You should actually avoid trading during that time, because he will be giving, sometimes he gives contradicting facts and leaves the market actually spiking on both sides. So it's better to actually avoid being in the market at those times. Then the second thing, after checking the news, you've gone through the news, the economic calendar, you've known which releases are going to be coming for that particular day, and you have written down the affected pairs, and you have left out with a bunch of pairs which we call a watch list. The next thing is now to verify the market bias. So before we hit the tradable M15 tradable time frame, we need to verify the market bias. So verifying the market bias means actually knowing or looking at the higher time frames to see where the market is actually going up or down. So in our case, this involves the counting of levels, location of peaks, EMA positions, and so. Since I've said we use the institutional market maker method, which we also teach. So some methods, I've seen there's quite a lot of methods in trading. Some uses the smart money concepts, some uses price action concepts, and so forth. So some methods will actually use trend lines, zones of demand and supply, order blocks, and so forth of the higher time frames. That can also gives you bias. So I'm not actually limiting everyone to the institutional market maker method. Some believes in other methods and they have actually proven them over time. So if you use those kind of methods, you have your own ways of actually verifying where the market bias is actually going. So after you've gathered the market bias, you can now say we are going up or going down. And as we know that if the higher time frame is actually going up, we know that the smaller time frames are building blocks of higher time frames. So if it's going up, it will be wiser for us to look for entry points or entry reasons on the smaller time frames that supports the higher time frame. So that is exactly what professional traders do. They first check news, verify market bias, and then go to the strike zone. So after you've seen whether the market is going up or down, it's time to get an entry point. And it is wise to make your entries on the smaller time frames like the M15 or even the M5 time frame. This is now to reduce the width of your stop loss. So make sure you have at least 2 to 3 reasons of entering the market. In our case, we would ask, have you seen the divergence on the Traders Dynamic Index or TDI plus an M or W? Or is there any railroad track present? And so forth. So you need at least 2 reasons for a confluence for your entry. If you actually have 2 to 3 reasons, you'd see that over a series of trades, you actually have a lot of them being winners. Then from there, we said news first, verifying the market bias, then looking for a strike zone. But before we actually enter the market, we need capital preservation techniques, which is now including the risk management and so forth. So in this case, the risk management is actually vital in trading. Actually, it is the only tool available for us that can allow us to trade or to actually lose and keep on coming back to the market with enough capital. So you should have your own trading policy on how much risk you expose your account to. Is it 1%? Is it 2% or 3%? It all depends on your risk appetite. But we say if you are still inexperienced, and by inexperienced, I've said it's someone who hasn't been profitable in Forex for 6 to 8 consecutive months. So if you're inexperienced, it's better to actually stick to the lowest risk available, a percent, and a percent or 2% will be okay. But if you are going to be trading with funded accounts from prop firms like FTMO, my Forex funds, it's better to actually stick to 1% only. Therefore, with any strike zone you get, you should try to set your stop loss on top of the high of day or the low of day, right? So we are saying this is the high of day and your stop loss should always be above that high of day. Then your lot size should be sized in such a way that if that trade goes against you, your account loses the set risk. So if we say our stop loss has been set, which is 0.1, if we are to lose this account, it should always be 1%, 2% or 3% of our account, depending on our trading policy. So this can all be done using Forex calculators that are available online, whereby you can actually input your trading balance and then input your stop loss price, and then it will calculate the rightful lot size for that particular trade. I've seen several traders actually asking me, what lot size can I use when I am trading? It's actually something that is not answerable from a professional trading point of view, because your stop loss should not be fixed. It all depends with the volatility of the market or the volatility of that particular pair. In this case, if we trade Canadian dollar against the Swiss franc, that's CAD against CHF, that will be different from GBP JPY against GBP JPY. Will actually have more volatility than CAD CHF. So it's actually wise to use forex calculators to calculate the rightful lot size for any particular trading. That is what professional traders do. So to summarize everything that we've said already, it's news first. From news we go to market bias. After market bias we go to the strike zone, and then capital preservation, and then after that we are now in the trade, right? So there are also techniques of how to treat a trade when it is actually moving. So the market moves in an irrational flow, right? By irrational flow we say we are going down, but you'd see it doing maybe this stuff, right? It's not a straight line. When you see some profit, you see that profit decreasing, another profit, it decreases, another profit, it decreases. So this actually will give you some emotions, and staring on all the point moves will only play with your psychology. And definitely, if you keep staring your moves, you definitely close that trade prematurely. So let the market do its thing, and your stops and target will be there to watch the price on your behalf. You've set the stop loss, and by setting the stop loss, it means you've actually made peace with that amount that is going to be lost if that trade goes against you. And you've set a target which you are expecting to actually hit. But staring at the market doesn't mean you are going to have any control over what is going to happen. It's either you are going to win or lose. So whatever outcome, move on and repeat the flow. If the market goes against you and hit the stops, if the market goes in your favor and hit your target, just move on and repeat the process that you have done before. So a key takeaway: if you go on social media, you see people staking a lot of trades on one single entry. You'd see some traders actually making hundreds of entries on one single entry. I would say, and I'll emphasize, never try this, otherwise it's the reason why you keep on depositing without withdrawing. So basically this is what professional traders do, and this routine should actually be printed down in your trading journal so that you won't get astray. And in this particular video we didn't talk of any strategy. You need to print down a proper strategy, and if you don't have one, we actually teach the market maker method, which is available at only $85, and you actually learn our full strategy. On that note, we come to the end of this video. Thank you for watching. Like and subscribe, and check out our free Telegram channel. I'll actually leave the link in the description box below so that you actually you won't miss any of our latest announcements. On that note, see you on the next one.